So today I'm doing the stocks that I'm buying in July 2023, the UK edition. This is the second most popular video series that I do on the channel after the US stocks I'm buying. So you guys, there are plenty of UK followers that follow me, obviously come here to check out, see which stocks I'm buying. So we'll go through this list, and the reason why I do these videos is so there's transparency, so you guys know what I'm buying, know what I'm selling. There's no hidden kind of stocks that I'm selling out in the background or that I'm buying and keeping it quiet, then eventually it goes up, oh look, I bought this stock 3 months ago and it's up so much. Everything is transparent here where you know what moves I'm making. So we'll go through the stocks that I bought recently. These are stocks that I bought from the 1st of June to the 1st of July. So I hope you enjoy the video series, and if you could hit the like button and we'll get started. And as always, if you do want to support the channel, join the Patreon. We post my live buy and sale alerts on there, as well as 2 exclusive videos. We just did the US portfolio review. We'll be doing the UK portfolio review in a few days time. It's only £5 a month. It's the cost of a pint, maybe even less than a pint if you live in London, but it's pretty good in my opinion for the value you get on there, and it's probably why it's the highest subscriber to patrons out there on the stock market YouTube scene, something that I'm massively proud of, because I do try to put a lot of work in there. And if you want to reward the channel for all this free information that's given to you, please join through there if you want to. Now getting on to the stocks, so first of all we're going to start with number 1. It's not National Express. I just wanted to put this on here because I knew if I did not mention this stock, I would have got a million questions about why National Express. Why isn't National Express on this list? Why isn't this here? You're not buying National Express anymore? Have you sold National Express? National Express just did not make the month of July. The reason why is there's only 4 weeks in there. I can't buy every stock in them 4 weeks. I still believe in the company, I still own the company, and I will continue to buy the company. It just did not make the list this time round because I wanted to just have a little bit of a pause buying the stock. And also when the share price was having a big massive falling knife trend as this was happening, I thought I'm just going to take a break from this one, and that's what I did. But don't worry, I still own it and I probably will still buy it, but it did not make the month, this list for this month. Just stops a million questions there. Now get on to the first stock. The first stock is S4 Capital. So I did buy some S4 Capital, and behind National Express, this is probably the second most stock I get questions on about S4 Capital. Now obviously the reason why is because the share price has not been performing very well. When the stock price did rally up from the summertime of 2022 and the stock market was up, the stock was up over 100%, there was not that much talk about S4 Capital, but obviously then it's giving it all back, and there's a million questions about S4 Capital and what's going on with it at the moment, and it just seems to be stuck in a downtrend, and there's not really a clear reason why. We've talked about this a million times before. I think the reason why is because a few people are spooked about the whole Martin Sorrell situation, but when you look at him and a lot of the presentations he's been doing recently, it looks like he's in good health. But I can't believe that that's pushed it down to 671 million market cap company. Now obviously we know S4 Capital operate in the name of Media Monks, and they are a digital marketing advertising company, and obviously we know with the environment that we're in, that's obviously not a good environment at the moment because there's a lot of companies that pull back the marketing spend. You know, when we look at the likes of Meta is a very similar company that has been hit by the pullback in marketing spend, and you can see here that they're currently only growing 2.7% year on year. But yet you look at Meta and the company has recovered massively since that time frame, and S4 Capital hasn't, which is a massive disconnect. And it's a really strange disconnect that's going on here, because you're then looking at S4 Capital thinking, well, is a lot of their marketing from the UK, and is, with the UK being a little bit more lagged behind the US, is that the why? Because of the economies? And that's not even true, because most of the revenue from S4 Capital now comes from the US, so that doesn't even make sense. So I generally don't know why it's down this low. It's absolutely crazy to me. Obviously these guys, like we said, to focus on digital marketing. This is an example from Starbucks: more content, more channels, lower costs that you get from using it. And the recent update was still okay. Obviously they were going through a weaker period where like for revenue was 6.1%. Obviously not what we want it to be. We want it to be a lot higher than that, but still, when you look at the companies like Meta's down at 2%. This is triple what Meta put in, and yet they are massively further down on the share price and take a massive beating. Same when you look at the financials of the company. The financial of the companies as well has been pretty healthy going forward. Apart from some acquisition costs and higher hiring, as you can see here, the company is now focused to get back to a break-even point of view, where the company is expected to now put 1.17 billion in revenue in, compared to a 671 million market cap. That's nearly a 0.5 times the sales. And actually, if we look at free cash flow, a free cash flow of 45 million by the end of the year. Same again, you look at the value value. That's about 15 times free cash flow, which is incredibly low. And obviously we should see the growth going back to high double-digit growth, and obviously analysts are starting to forecast profitability start coming in. Obviously the acquisitions costs start coming out, and also free cash flow of 80 million. Now obviously if you got 80 million, you're under 10 times free cash flow. You're talking around about 6 times free cash flow there, which is absolutely insane. And even if you talk 60 million on earnings, if they were able to do that, you're talking about the company around about 11 times earnings, which is just insane that this is how low the company has kind of got to now. Financial health wise, still pretty healthy. They sit around 38% debt to equity, which is really healthy as well. I just think this is crazy low for this company, and as soon as marketing starts coming back next year, we should see this do very well. The next one is Supreme. So obviously you guys know, I mentioned this not too long ago on the YouTube channel. 131 million market cap company, is listed on the AIM. It is a 13 times earnings, which once again I think this is way too low for the company and the numbers they're doing, and it pays a dividend yield of 2.67%. Now if you have a look at Supreme, they are a seller of products and also a distributor of products, and if you actually look at the recent results, they were absolutely fantastic. They actually came in ahead of what analysts were guiding for, and yet since that time frame the stock is only up around about 6% now since doing that trading update, which is just absolutely crazy for how strong this was and how ahead of the numbers they were. Robust trading across financial year 23 and particularly strong second half. You can see here they also gave a very positive outlook supported by significant profit upgrade for financial year 24, revenue growth of 19% as well, and you can see here that they also increased their dividend and they're offering dividend growth here, and also you can see here that they are now expecting adjusted EBITDA to be ahead of expectations by at least 1 million as well. In addition, the group has now expected a further 25 to 30 million of revenue and around 2 million incremental adjusted EBITDA in financial year 24 in respect of a master distributor appointment in the UK's leading vaping brands Elf Bar and Lost Mary. As a result, the board now anticipates that trading in financial year 24 will be significantly ahead of current consensus. So this company offered a massive upgrade on their guidance going forward, and the company was only up 6%, which is absolutely crazy. If you look at the company, like I said, it trades at 13 times earnings. The revenue growth is set to skyrocket, as you can see here, and we should see around about 200 million in revenue by 2025, and as well the profit should as well start going up as well, so we should see good amounts of profit growth. You can see analysts are actually upgraded the forecast now on Super Wall Street, which didn't happen the other day, so they're expecting around 13 million-ish of earnings by the end of 2024, this financial year, and you can see that will put them around about 10 times earnings for a company that's putting this amount of growth in. Absolutely bonkers. And also, like we talked about, you're getting a really good amount of dividend growth going forward, and all I can see is the company, as well as they continue to win contracts and also the vaping growth that they currently have, it looks like this company is in a very good position. The next one is Alphawave Semi. So this company has had a massive tumbling since the IPO, and obviously you guys know is that I started buying this company as I think that the company has now sorted out some of the issues that they previously had and are now moving back into a positive direction. Now if you don't know what Alphawave Semi do, they sell silicon IP, but the big growth is going to be moving into chiplets and custom silicon as well, and this is going to be major growth for the likes of data centers, 5G, the AI boom that we've seen. And I think this company, when you look at a lot of other companies at the moment, a lot of companies have been having a major boom because of the AI situation. Alphawave isn't having that, and for me this is the play into the semiconductor space and the AI space, that a company that is being slept on massively. Now this company has done really good growth previously, but going forward as well they should do pretty good growth going forward, and they actually offered some long in the investor relation presentation they did on the 19th of May. They offered some longer term guidance on what they were hoping to do. So you can see here they're expecting to do 185 million up to 340 to 360, and then by 2025 they want to aim to be over 500 million. The gross margins will go slightly down because they are offering obviously from an IP to an actual more physical product, which is absolutely fine. But you can see adjusted EBITDA as well is going to go from 47 million to 87 million to 150 million as well going forward. And as you can see here, where the company was previously just an IP business, all the other IP licensing, custom silicon and connectivity products start coming in as well going forward, and this is a major change for the company and should drive growth going forward. And right now the company is going to be trading around about something like 20 times earnings, but obviously the growth, if they can drive up the revenue growth that they say, obviously that you're going to have a really good amounts of revenue growth, as you can see here. The company should grow around about 20 to 30%, and also the earnings point of view as well, they should grow earnings as well at a really rapid rate, and that suddenly looks very cheap going forward. So I think it's a little bit of a higher risk play that I have in here, but I think it could do very well because of the AI boom. Next one is MoneySuperMarket. So I did take a little bit of a nibble at this one, not much, because I do want it cheaper. I want it to be more around the £2 range, but I did nibble some shares. 21 times earnings, 4% dividend yield. I think the dividend yield will also get hiked up as well going forward. Obviously a comparison site, compare between car insurance, home insurance, travel insurance, life insurance, pet insurance, credit cards, loans, mortgages, mobiles, and broadband. And obviously the big thing is they have lost their energy part of the business. This is a massive hit for the company when they lost energy part of the business, and I think this will come back in the next 12 months, and that'll be a really big boom for the company going forward as well. Even without the energy part of the business though, the company's been flying. All the other parts of the company have been doing very well. And even though the home services lost about half its revenue, it has started to bounce back now without that. And you think if that comes back in, it should be very good as well going forward. And as you can see here, this was the impact of the travel insurance and the energy situation coming into the business. And if we look at the growth at the moment, you can see that that is now starting to forecast or starting to come back to revenue growth going forward, and the profits start being driving up. Previously, you can see the company before the whole CV situation was doing about 100 million in profitability. I would expect them to get there within the next 24 months. And you can see here, analysts are forecasting by that time that they will get to 100 million in 2025. So something similar to what I'm thinking as well as the revenue growth. Obviously 100 million puts it around about 14 times earnings, which isn't too bad. As well as that, my big thing is that will also go to a big amount of dividend growth. Financial health wise, it's pretty solid on the balance sheet, and if you look here on the dividend, like I was saying, they currently pay around about 4%. And as you can see, analysts are forecasting, I think that will easily go up to 5% by 2025. Obviously, that's a very good dividend yield as well, and also collecting, I would expect a 50 to 100% share price appreciation off this one in the longer term. And on the insider front, there has been a lot of insiders buying on this dip as well, which also gives me a lot of confidence. The next one is JD Sports. So this company is starting to head now towards the lows of the CV times, which I cannot believe. Obviously, this is a stock I've owned for a while, and obviously now I can't believe that we are kind of them sort of levels where we were at kind of around that 2020 time. The company's absolutely flying, which is crazy. If you have, obviously you guys probably will have seen JD Sports around the UK, but the big thing is the expansion they're currently trying to do into the US. They're trying to break the US market at the moment, and the recent trading update was pretty strong. You can see here the growth was still 15% year over year. The board maintains its profit targets that it was aiming to achieve. This goes on at a time period where you're seeing something like Nike and Foot Locker putting weak numbers at the moment, so that's obviously really good. They're still doing pretty good in this environment going forward. And if you actually look at the financial performance of the company here, you'll be able to see here the growth that they've had since 2020 during them CV times, and you can see, look at this here, look at the growth of they're nearly doing double the revenue, and you can see here, apart from the current dip that they're having, the one-off payment that they've got to do at the moment, you can see here they're doing the forecast in January 2024 to do 705 million in profit. Now if you look at previously what they were doing before the whole CV situation, it was around 252 million, so they've nearly tripled the profit, and the company should carry on growing at good amounts of growth and the profit growth as well going forward. It just looks absolutely crazy. You're going to be talking about the company's trading around 10 times earnings with this growth. We should be talking, this is a premium, UK company. We should be talking 20, 30 times earnings, which is just absolutely crazy. Financial health wise as well, obviously still pretty good, only 4.3% debt to equity. They do pay a slight dividend, but I won't really be getting into this for the dividend point of view. And you can see here, insiders have been loading up the shares as well, which is obviously a really good sign. So yeah, JD Sports is a very tempting one to me to keep buying, because I think it should be pretty much at all-time highs at that £2 range, and it's not. So I am really watching that one at the moment. The next one is Fawltera. So I did buy some shares in Fawltera, 6 times earnings, 9% dividend yield. There's questions around whether there will be a dividend cut or continue to be cut going forward. That's the only thing that I'll be saying about it. But obviously it's focused in the building products. Everyone is worried about the housing market weakening, the demand weakening as well, and obviously the people are thinking that this will continue to do badly, or will do badly, and it probably will do. But over the next few months it will be a bad stock that probably won't do well. But I'm thinking more 3, 4, 5 years it will rebound, and I think if I can get these shares at these prices, I'll do very well. You can see here it's basically sitting at the lows of the whole CV situation. That's where it's currently at right now. They are making good investments though into their building supplies. So they are focusing on the brick factory. They've done a big investment there, as well as that some other investments inside the company. So when the housing market does come back, these guys should do very well, and it will come back. The housing market in the UK will come back. We are short on houses, and obviously as soon as we find that the interest rates stabilize and people know what they're going to be paying on their interest rates and mortgages, and also as soon as there's a dip in the house prices, you're going to see, because the market slowed down so much over the last 12 months, there's going to be such a demand for people to get back into buying houses. There's going to be a major boom, and because Fawltera made the right investments, they will be really benefiting from that situation. The company itself, as you can see here, very good track record of growing revenue and profit, and I would expect them to go back to these sort of levels once the housing market stabilizes. They'll also the good thing is they can weather the storm, because they've got a pretty healthy balance sheet. As you can see here, only 18% debt to equity, on 34 million of cash, which is good, and they should be able to go back to obviously paying that dividend, which, like I said, we could see a little bit of a cut going forward. But if they go back to the old levels of profitability, you're picking up a 8% dividend yield. Obviously the share price will start to recover. I think it will be a combination of both of them, so I reckon there'll be a bit more of a pain over the next 12 months for this stock, but in the longer term, with the UK housing market situation, I think these guys will recover. On to the second last one, which is Jet2. So a bit of a mixed bag with this one. 9 times earnings. These are a little bit of a dividend yield here. The share price has been really stagnant since 2021. Hasn't really done much, but I think it should be starting to push to all-time highs sometime soon. The reason why is travel demand is going absolutely crazy. Obviously, you guys probably know they do the holiday packages, also the airlines. Obviously, at the moment, UK holidays are going crazy, even though in this environment, it shows you people are prioritizing half the whole CV situation. We still want to get on holiday massive. And actually on the recent update, you can see here, the revenue was 40% year-over-year growth, even after 2022. Profit as well went absolutely crazy as well. Absolutely, dividend came back, absolutely crazy numbers from the company. And you can see here, before the whole CV situation, 3.5 billion in revenue, 111 million in profitability. And if you actually look at what they're going to do right now, they're forecast in 2024 to do 346 million profitability, nearly treble the profitability, and revenue as well is up to 6 billion. You can see these guys capitalize massively from the CV situation, with a lot of the other airlines that are struggling massively, and they should continue to do well going forward. And you can see here, if they do achieve the 346 million profitability, that will put the company around about 7 times earnings. Absolutely unbelievable there to see that from here, and obviously already trading at 8 times earnings. So yeah, it's absolutely crazy to see how this company is doing. Financial health wise, they have started to strengthen the balance sheet up a little bit, and you can see here they do sit on 2.6 billion in cash and 729 million of debt, so that's very healthy from that point of view. They've got a lot of cash there, could pay that debt off if they wanted to. Dividend, they probably still hold that dividend very stable. Now the only issue is that I would be loading up these shares at the moment, but the only reason why I'm not loading the shares up at the moment is because of this. If you look at the insider front, you can see here Philip Meeson has been selling a few shares off. Now the problem is that he owns, and he's done a fantastic job, he's the chairman of the board and the executive chairman. He owns 18% of the business. Now the shares actually took a dive off the recent trading update, even though they're absolutely fantastic. As you can see here, the dip that they did go on, because he did come out with a statement as he's going to step down from the board. Now the worry is that he owns such a big chunk of the business. Obviously that's a lot of shares that could potentially come onto the market, and I also thought that if it wasn't for that, I would be buying these shares a lot at the moment. But there is part of me thinking, is he going to be dumping a lot of these shares, and will that keep the share price down? So yeah, obviously that's new information that's come out here at the moment, and I'm thinking on it at the moment where to go, because of what I will be buying absolutely crazy, but I don't know if that's just going to hold the share price back a little bit at the moment if he's releasing a lot of capital. So I'm going to think on that one, but I'm not selling because I do think it's undervalued still, but it might stop me being from as aggressive as what I was anyway. And the last one's Legal & General. Obviously you guys know Legal & General, it's been on the list for a while. I actually thought, I can't believe like I've owned this one for like nearly over 3 years now, and if I own it for 3 years, I'd only be up 12%. I think I'm about break even at the moment, but I've been doing a lot of averaging up on this position. So yeah, about break even after all these 3 years of holding it. But obviously it doesn't show when I do the portfolio reviews, like dividends being collected as well. Obviously would have been collecting a really good dividend from this one. 6 times earnings, 8.8% dividend yield. A lot of people question the dividend yield. I think it looks pretty okay at the moment. Obviously, you look at Legal General and they're involved in investments, pensions and retirement, insurance. Pretty stable business, as you can see. They recently did an update on the financials, and you can see here they basically said the long-term targets that they set out a while ago still continues going forward. They can see here they are happy with the guidance at the moment going forward as well. Inside the company as well, there's been a ton of shares being bought by different people inside the company, which obviously is real. I mean, look at this list. This is one of the longest lists I've ever done. So you can see here 31k in the last 3 months, another 21k, another 41k, another 44k. So there's been a lot of insider activity as well going on at the moment, which is obviously a really good confident boost. And like I say, a lot of people are saying about the dividend yield potentially being at risk, and at the moment I don't think there's much risk to that dividend. I think the should still carry on paying that dividend. You look at the cash, look at the profit, they should be okay covered for it, so don't see much there. So yeah, I think it's just having a bit of a dip because of the situations that we're having currently in the UK, and I think it does look a little good opportunity to nibble at, so I did buy some Legal & General. That is the UK stocks that I have been buying. I hope you enjoyed the video. It was a long one. Like I said, I am seeing the opportunities in the UK market at the moment, and that is proof of that when you look at that video there. Hope you enjoyed it. Smash the like button. See you in a bit.